Markets are shaking. Your portfolio might be too. Trump's tariffs are back, and they've sent global financial markets into chaos. But here in Singapore, one question matters most. What should I do with my investments now? Should you sell everything? Buy more? Wait. If you're 25, 45, or even 65, don't move a muscle because this video is made for you. And if you stick around till the end, you'll walk away with a clear action plan to protect and grow your wealth no matter what happens next. We'll cover how the trade war affects you, what Singapore investors age 25 to 45 should do, what those age 45 to 70 must focus on, and how dividend investing can give you peace of mind, even if you lose your job. You're watching Wealth for You, your guide to growing money the smart, steady way. Like this video, subscribe, and hit that bell so you never miss a strategy that could change your financial life. But before we dive in, a quick disclaimer. This video is for information and education only. It doesn't consider your personal financial situation. Please speak with a licensed advisor before making any big money decisions. Part 1. Why Trump tariff matters to Singapore. Trump announced a fresh wave of tariffs. It sparked fear across global markets. Even Singapore was mentioned in his board of tariffs, despite us having a trade surplus with the U.S. Stocks dropped, bond yields fell, oil prices slid, and the markets are signaling trouble ahead. Singapore's economy is trade-reliant, 3 times our GDP. Retaliatory tariffs can reduce global demand. Weak demand equals fewer jobs, weaker pay growth, and market volatility. Part 2. The long game still works. Here's the good news. This is not the first time we faced a once-in-a-century crisis. In 2008, the global financial crisis wiped out trillions of dollars and left even seasoned investors shaking. In 2020, COVID-19 locked down the world, crashed markets overnight, and sparked fear everywhere. And today, trade wars, rising nationalism, and protectionism are threatening to derail global trade and economies again. But here's the thing. Markets have always bounced back. Not just once or twice, every single time over the long run. So if you've got 10, 15, or 20 years to invest, you don't need to panic. You don't need to sell. You just need to stay the course, keep investing regularly, and let time and compounding do their job. It's not timing the market, it's time in the market that builds wealth. Part 3. Investing advice for 25 to 45-year-olds. You're building your career, your CPF, maybe starting a family. Here's what to focus on. 1. Time is your superpower. You can afford to ride out short-term volatility. Stick to your long-term asset allocation. Don't panic sell. 2. Dollar cost averaging. Invest regularly, even when markets are down. You're buying more units at lower prices. 3. Build a dividend income stream. Start early with REITs and dividend-paying stocks like DBS, Singtel, or Mapletree Industrial Trust. These help build cash flow, even if your job gets disrupted. Think of it as building your financial muscle before the real storm hits. Part 4. Investing advice for 45 to 70-year-olds. You're preparing for retirement or already there. The stakes feel higher. Here's your approach. First, prioritize stability. Focus more on quality dividend stocks, REITs, and balanced portfolios. Cash flow is king. Second, don't overreact to noise. Markets will recover, but emotional investing is the real danger. Stick to your plan, unless your time horizon has truly changed. Third, diversify income sources. Add CPF Life, SRS investments, and diversified dividend ETFs. Think Lion OCBC Securities APAC Financials. Dividend Plus ETF. It gives you exposure to Asia's big dividend players. It's not about chasing returns, it's about creating income for the next 20 to 30 years. Part 5. Why dividend investing helps in a crisis. Here's why dividends matter, especially in a job loss scenario or weak economy. They give you regular passive income. They provide psychological comfort during downturns. You don't have to sell your investments to pay bills. And if you reinvest them, you boost compounding returns. For example, a $50,000 portfolio yielding 5% gives you $2,500 a year. Reinvested, it grows faster, even if prices are flat. Part 6. Don't try to time the market. Selling everything and waiting for the right time sounds smart, but it's a trap. You'll likely miss the recovery. Even missing the 10 best days in the market can cut your returns dramatically. The market turns before the economy does. So unless you have a crystal ball, it's better to stay invested. Part 7. What you can control. In uncertain times, it's easy to feel powerless. But here's the truth. You can't control the global economy or Trump's next tweet, but you can control your own financial choices. Here's what smart investors in Singapore should be focusing on right now. Safeguard your income. Keep upskilling, stay relevant, and make yourself hard to replace, especially with layoffs looming in some industries. Cut down unnecessary expenses. Subscriptions, impulse buys, excessive dining out. It all adds up. Trim the fat, build a buffer. Reduce non-mortgage debt. Credit card bills, personal loans, car loans. These drain your finances and limit flexibility in tough times. Build a buffer in your CPF OA. Make sure you've got at least a few months' worth of mortgage payments parked safely in case of job disruption. Avoid high-ticket liabilities. Unless you're already financially very strong, now's not the time to splurge on a luxury car or stretch your finances for a flashy private condo. The monthly payments alone can crush your cash flow if the economy turns. Don't sell your long-term investments. Unless your goals or time horizon have truly changed, don't turn a temporary paper loss into a permanent one. Remember, your wealth isn't just about what you earn or invest. It's also about how well you manage your spending, how you mitigate risk, and your discipline, especially in times like these. Closing thoughts. When the world feels shaky, go back to the basics. Stay diversified. Keep investing regularly. Build dividend income. Protect your savings. Stay calm. Stay long-term. Crises don't break your plan. Emotional decisions do. So whether you're in your 20s or in your 60s, the key is to stay invested and stay prepared. Let me know in the comments. What's your biggest investing concern right now? Don't forget to like, subscribe, and share this with someone who needs this clarity. You're watching Wealth for You, helping Singaporeans grow their money the smart way.